All right, let's get going. My name is Jason Richardson. I want to thank all of you for joining us today for a look at our new report on the great consolidation of banks and the acceleration of branch closures across America. This report was released last week, actually week before last at this point, and I'm going to be putting some links in the chat soon to the report as well as some other material. So please take a minute to look at the chat in just a few minutes. Also, we have a question and answer session coming up at the end of this webinar. So if you have any questions, there should be a Q&A box at the bottom of your screen. Feel free to go in there and type in your question, and we'll try to either answer it online or on the call. At this point, I'm going to introduce the rest of the team. Dr. Bruce Mitchell is with us today, and Jad Edlebi, who is our senior GIS specialist. We're going to go through this report, and then we're going to have probably about 20 or 30 minutes for Q&A at the end of the presentation. So please hold your questions until then. Let's go to the next slide. Okay, and most of you know who NCRC is, but we are a 600-member group organization. We help our members with a variety of data and research needs from my team, including working with data like the branch data that we talk about in this report. Now, this report does not go in depth into analysis of metro level branch networks. We do offer several tools that can help do that, including our Fair Lending tool, which is available to members on our website. We can also help members with custom research requests. So if this report gets you interested in what's been happening in your community and you want to know more about these closures, after the webinar, feel free to shoot me an email and we can talk to you about how we could help you look at those branch closures in your area. Next slide. And next slide. All right, let's take a look at the broad overviews of the report first of all. Next slide, please, Jed. We're going to discuss really two different time periods here. We're looking at in a couple of different issues that we touch on. We're going to look at bank branch closures as well as the long-term trend in bank consolidation and merger activity. The first part of our discussion, we're going to look at somewhat of a decade-long trend we're seeing in both the consolidation of banks and the closure of bank branch offices. In the second part of the presentation, we're going to focus on a very specific time period, the 20-month period before and after the beginning of the pandemic in March 2020. Next slide, please. A couple of high-level takeaways that I want to start off with, and then we're going to talk about these more as the webinar progresses. First, in the last 40 years, we've seen 2/3 of banks disappear in the United States. Mergers and acquisitions have resulted in a growing number of large national mega banks, but the small community banks have by and large disappeared. This also drives declines in branches, and yes, there are other factors that result in branches being used less, such as mobile banking and online banking, but mergers are a primary driver of it as well. And as America grappled with the pandemic, we do see signs that branch closures accelerated sharply, and Jad's going to be showing some charts and an interactive graphic that are on our report that talk about that. Next slide. And why does this matter? And whenever we talk about bank branches, there is always kind of that pushback or that feeling that bank branches maybe aren't as important as they used to be, but they remain critical for several things. In this report, though, we want to talk also about the disappearance of community and regional banks, the ways in which bank branches support local businesses, and the disparate impact that we might see in low to moderate income, high minority, or rural areas where they already have fewer branches to begin with. Next slide. All right, at this point, I'm going to turn things over to Dr. Mitchell. He's going to talk about the long-term trends for institutions and bank branches. I'm also going to post a couple of links into the chat. Please take a look when you have time. And remember, if you have any questions that you think of along the way, put them in the Q&A box, just like, oh, great, Herschel's already gotten us started. All right, I'm going to turn things over to Bruce.
Thank you very much, Jason. So for the study, we looked at both institutions, which is the great consolidation part of our analysis, and at changes in the number of bank branches nationally. The great consolidation of institution, it's taken place over a long term, the past 3 decades. While the branch closures we looked at in terms of both the long-term trends and the short-term pandemic era changes that have occurred. Next slide, please. So our key findings in terms of institutions are, first, that 2/3 of banking institutions that were operating in the early 1980s, they've either closed, consolidated, or merged into ever larger institutions. Second, in terms of impact, small banks have been the most affected. In the early 1980s, 84% of institutions were small banks holding less than $330 million in their assets. That's changed. Today, only half of the banks are in the small institution category. Of course, how you evaluate that category has changed a bit too. Those are banks with less than $1.3 billion in assets. Third, mergers and acquisitions have driven much of the branch closures, though technological change in delivery of financial services through the internet and mobile banking are also factors in that trend. Next slide. Going into more detail on institutions. Here we can see in this slide, we can see that in 1994, there were over 11,300 banking institutions, the majority of which, 9,500 of these, were small banks. Over the past 27 years, this has declined to less than 4,500 institutions in total, a little over half of which are small banks. On the other hand, the ranks of the largest banks has actually increased. This has been an era of major restructuring of the banking industry, which largely resulted from statutory changes and changes in the regulatory structures of financial services. Next slide. But why does this matter? Why do things like small community banks matter? There can be many benefits, after all, to banks, and consolidation as they achieve greater efficiency by streamlining their operations, economize by reducing overlap in services within their market areas. But there are concerns that this sort of consolidation, while benefiting shareholders, does not necessarily benefit the customer base. And also, there's the demise of the small community banks. Reasons are, first off, this concept of relationship banking we see here. That small community banks, they're more likely to rely on contextual information beyond just credit scoring or bank statements when assessing the quality of a business and whether it is indeed a good lending risk. Additionally, because of relationship banking, community banks are key providers of funding to local businesses for commercial real estate loans, agricultural loans, as well as small business loans. Both of these factors were reasons that small community banks played a key role in maintaining access to credit during the global financial crisis and also during the COVID-19 pandemic, when small businesses were greatly reliant on their banks to provide that lifeline for their payroll operations. Second, institutions taking local deposits are also making local loans. Small community banks are focused on meeting the business needs of their community, and those deposits are more likely to stimulate investment in that specific area. Finally, many small banks are also nonprofits, meaning that they have missions that are focused on maintaining financial access for their members of their community, rather than just on the needs of increasing shareholder value. Next slide. So this great consolidation has had an extraordinary impact on the structure of bank operations nationally. If we turn to trends in branching, there are several key points. First is 9% of branches closed between 2017 and 2021, resulting in the loss of about 7,500 locations over those 5 years. Second, the pace of bank branch closures accelerated during the pandemic, doubling between March 2020 and now, from an average of 99 branches a month to 201 branches during this past 20 months. Finally, while closings in low to moderate income areas and minority communities were commensurate with those in middle and upper income white areas, there was less capacity and greater reliance on physical branches in those areas to begin with. meaning that the ultimate impact could have been even greater. 1/3 of the branch closures were in low to moderate income or minority communities during the period 2017 to 2020. Next slide, please. So branches, they used to be an important way for banks to gain market share, right? Banks would expand their geographic footprint in order to increase their market share. And this meant having a branch location in the neighborhood to take deposits, sell services. And up until the 2007-2008 financial crisis and subsequent Great Recession, this was their market strategy. After that, there's been a gradual decline in branch locations, as many banks failed and were consolidated as a result of the financial crisis, and also as the internet and then mobile banking became more prominent ways for customers to gain account access. So the dynamic after 2009 has been one of greater consolidation and closing of branches. Next slide. And these impacts of closing branches, they vary quite a bit by metro area. Here we can see the metro areas that had the highest intensity of branch closings in those areas. So Portland lost almost 20% of its bank branches, and that's Portland, Oregon. In this case, 20% of their bank branches, followed by Baltimore, Hartford, New York, Sacramento, and Phoenix. And all of those metro areas lost between 13 and 14% of their branches. So metro impacts have been quite different across the country. Next slide, please. And this shows in greater detail the increase in branches, which topped out in 2009 with about 95,000 total branches in all areas of the United States. This has declined by 13,000 since that time. If you look at this kind of steep roll-off you see at the end there, though, between 2020, 2021, you can see that the pace of closures has accelerated, a fact which my colleague Jad Edlebi will speak to you in more detail. Jad?
Thanks, Bruce. So we began to talk about the rapid acceleration of branch closures across the country and how that sort of perspires geographically. I'll be showing you guys how that works within our interactive charts. So pandemic era branch closure rates exceeded even the highs reached in the wake of the financial crisis in 2010. There were approximately 1,500 closures and just 330 new openings during the fourth quarter of 2020, leaving about 1,162 net closures. This greatly accelerated pace of closures may indicate that banks are using the pandemic to dramatically reduce their physical footprints. And if you can see in the chart on the left side, there is a gradual increase of closures since 2010. Right when it gets to 2020, however, there is a really big spike. And that started happening within the third and fourth quarters. It is greatly attributable to the pandemic, and it's definitely felt. Beginning about 3 months after the start of the pandemic, most banks responded by dramatically increasing the rate of branches they closed each month. Bank branch closure rates nearly doubled in the wake of the first pandemic lockdowns. In 20 months of post-lockdown FDIC data available show that banks shuttered 4,025 branches from March 2020 through October 2021. That total number is about twice from the total from the prior 20-month period before the pandemic. And some individual banks have far exceeded even this dramatic acceleration in closures. HSBC, for example, which you see at the top of the list here, has closed 88 branches since March 2020, after closing only 4 in the prior period. Such outliers aside, every bank in the data set seems to have begun closing branches en masse about 3 months into the pandemic. And the data offers no indication the closure rate is slowing. While the intensity of the pace of branch closures increased nationally, several large metropolitan areas saw banks retreat from branch service at an even faster clip. Banks closed twice as many branches in Los Angeles during the pandemic as they had closed in the prior 20 months, for example, while closures tripled also in Washington, D.C. In other cities, the rate of closures accelerated even more, with Boston and St. Louis closures increasing by over 1,000%, while San Francisco and Atlanta followed with exceedingly high numbers as well. Smaller metro areas were also hit hard, and one in particular, Grand Rapids, Michigan, had the highest increase in local branch closure rate at 3,500%, while in Columbus, Ohio, the rate was 580%. The metro areas of Baltimore, Las Vegas, San Diego, Pittsburgh, and Portland, Oregon also saw their closure rates more than tripled as well. Only Chicago saw the rate of closures decrease during the pandemic. So I'm going to go ahead and show one of these interactive charts on our report on our website, and we will also send a link to the report in the chat. So here's our report on the webpage. If you would actually scroll down from the top here, it's a bit further down. This is the chart that I'm talking about is an interactive map that basically talks about the closures and openings throughout the country. And it's this one right here. So it's a lot to take in, but I'll break it down. So right now you're seeing the map with closures marked as black and openings marked in blue. And in the background, we see median household income by census tract in 2018 in dollar amounts, with darker colors indicating higher household income. And the bottom chart here shows openings and closures in the same color, with interactivity also shown. This interactive chart is very useful in that you can actually siphon down to specific areas. So for example, I'm going to go ahead and go to the San Francisco Bay Area. Okay, you can already see some adjustments being made. Over here, you'll see that there's a net change number. And this is basically the change between 1999 and 2021. This is also interactive. You can switch this to say March 1st, 2020, the beginning of the pandemic, and that should also start adjusting. Right here is a spike in 2020 in Q4 where 37 branches had closed while 2 branches opened. And in the entire period between March 1st, 2020 and November 15th, 2021, 85 branches had closed in the San Francisco Bay Area, as well as 11 opened, leaving a 74 net loss in branches in the area. So that's basically the gist of this very useful tool that you can easily use in your own geographic scope. It queries to metro areas and counties across the United States. So I'm going to go ahead and bring this back over to Jason for policy considerations.
Thanks, Jad. That was great. Let's go to the next slide. So we've already got a couple of great questions in the Q&A, but I want to go through a couple of quick slides and then we can turn to the Q&A part of this discussion. So first, why do branches still matter? And this is a common story that we hear from well, anybody when we talk about our branch reports. The fact is that branches still fill a number of important roles, and they do so for some communities that we are really interested in supporting. First of all, they are critical to supporting small businesses in a number of ways. Small business lending still tends to be relational, meaning that there's often a business specialist at a branch that has ongoing relationships with business customers. We are hearing that this is changing over time. There is more automation to business lending in some ways, but it still remains a critical way in which branch staff support local businesses. Moreover, businesses also use branches for other things. They get change from businesses to open. They may make deposits at businesses with cash deposits. These are all things that are a cost for a business when the branch closes. In addition, older, lower income and rural consumers are more likely to rely on branches and are less likely to use online options. The FDIC puts out an excellent biannual survey that talks more about this, but we do see greater and greater adoption of mobile and online banking across the board. However, these populations and that many of us are critically are concerned with are less likely to be moving to mobile or online banking, so the closure of branches can have a bigger impact on them. And finally, equitable closures do not always equal equitable impact. What I mean by that is that in low to moderate income, minority, and rural areas, there are already fewer branches. So even if the closures by banks are equitable in the sense that they are equally distributed, the fact that these areas have fewer branches to begin with often means that the impact there is going to be higher. Next slide, please. Regulators should facilitate discussions between banks, communities, and nonprofit lenders and community groups to mitigate the impact of branch closures on surrounding communities. And what we mean by that is when a branch is closing, meet with the community, meet and talk to the consumers and tailor a process to close the branch with as little disruption to those people as possible. And this may mean helping them figure out online banking or mobile banking. It may mean transitioning business customers to other relationships at other branches or to online options that work for them also. The Community Reinvestment Act should be updated to address a market where bank branches are no longer sufficient to define bank service areas. So many of you are going to be familiar with the Community Reinvestment Act. The Community Reinvestment Act evaluates banks and their performance at community investment in low to moderate income communities based on where they have branches. So when a bank closes all the branches in a county, for example, they no longer have CRA obligations in that county. NCRC has done a lot of work and we published a lot of comments on ways that we think that should be updated. And also, this report is not an easy one to work with because of the data quality. The data on branch locations in the US is fragmented across several different databases without really clear data dictionaries or methodologies. So in this report, we're blending a couple of different data sources from the FDIC, but it still was difficult to work with. If you are working on research of your own on bank branches in a local area, and you're a member of NCRC, please talk to us and we can help you kind of get through dealing with some of the more unusual aspects of this data. Next slide, please. All right, I've already shared a bunch of links in the chat. You can scroll up there and find the links to the report that I have here. The link to these slides is also there. There's also a link to the Fair Lending tool. That's a tool that members can use to look at, amongst other things, bank branch locations in any area in the country. And if you're not a member of NCRC, I think Maggie is on the call. Yes, Magdalena is on this call. She's in the chat here. There's an email for her. If you're not a member of NCRC and you're interested in learning more about the research benefits that we offer to members, or more about the Fair Lending tool or other reports that we've worked on, please let us know. You can email myself and or Maggie and we can help out with that. Next slide, please. Just more on membership. And I think that'll do it. Jed, why don't you go ahead and stop sharing and we can transition over to the Q&A segment here. There are already some good questions in the chat. I'm going to start off with a couple of them, but if anybody thinks of a question, please feel free to stick it in the Q&A box there. And starting us off really strong, Herschel Daniels and Phyllis Logan put in a couple of great questions. From Herschel, with the switch to digital banking is not the end of traditional branches at hand. I wouldn't say the end is at hand, but certainly there's a big transition going on. Branch decline has been steady since about 2008. And yes, that is the time of the Great Recession. That is also when the iPhone came out. The impact of mobile banking on people's use of branches is substantial and real. However, it does not mean that there is no need for branches, and consistently we're finding in surveys and other data that branches are important. One of the links I put in the chat was to a report that we released last year on small business lending and bank branch locations. And what we found was that when branches, we found that when branches are closed, there is an impact on small business lending in the surrounding area over the next few years. And this is just part of a larger body of work from other researchers that have found the same thing. There are changes coming in communities where there's a lot of economic activity. You may see non-banks come in to take up some of that slack when the small business lending from banks declines. The challenge, of course, is that those non-banks are not covered by CRA. So there is no attention to whether or not they're lending to low to moderate income business owners or in low to moderate income areas. So that's a concern. And Phyllis notes that we service a large population of elders who are not tech savvy. What options are available to them, and how do we be the loud voice for them? Exactly. Older consumers, low to moderate income, and rural consumers, we know consistently use branches more, and they're less likely to use mobile or online options. So we hope that banks and regulators will work with community groups when they are closing branches to think through how they can mitigate the impact of those closures. But we don't see anything indicating that the closure rate is slowing. Obviously, in the pandemic, we saw an explosion in the volume of closures, but over the long term, it does appear that the numbers of overall branches are going to continue to decline. Let's see, there are a couple of questions there. There's another question. Mark Fleury asked, do these numbers include credit unions and that they've opened their business to whole communities, while in the past you had to work with a family member? Yeah. So this data set does not. We pulled the FDIC bank branch location data. NCUA does publish credit union data, but they are not included in this report. Let me see. So Phyllis asked a question here. Can you share the demographic areas where people of color live and where there's a large population of 50 to 85-year-old residents who need public service? We certainly have that data. This report doesn't dive into quite such a detailed analysis, but I think that's a great thing to look at and then understand the closures in just, in the sense of who really lives in their service area. And that kind of gets at my point that I would hope that banks and regulators and local community groups can work together to think through the individual implications of branch closures. So if a branch closes in an area that has a large small business population nearby, and they do a lot of small business work, I would hope that they would help those small business owners transition to working with another branch, or to working with to working with another branch, or to working with somebody over the phone or online with the same bank. If they're in an area that branches in an area with a significant elderly population, I would hope that they would work with those consumers to teach them more about mobile banking and help them kind of adopt some of that, those tools if possible. But then that's what I mean when I say mitigate the impact. Branches are going to close. We can't stop that necessarily, that long-term trend that we see, but we can think through how we can make those closures less painful for communities. Jackie asked, how does bank closures affect employment rates? And they clearly do. We don't have very good data on this, though. So for example, when a branch closes, we don't know how many staff are released, how many are transferred to other positions with the same bank. That's an excellent area for future study, though. And I'd like to point out the increase in closures during the pandemic, is problematic from a number of ways, especially if a lot of those employees were immediately having to go on unemployment or other types of public benefit. Yeah, and Herschel points out, the business lending is regional specialists, not in branches. And we're hearing that in other ways. With the smaller banks, community banks, you see more of that relational lending, I think. But with the larger banks, they've moved away from that branch model in a lot of ways, I think. So yeah, and that's part of the changing landscape of banking and what the branches are really for. We're seeing banks experiment with a lot of different formats of branches also, most notably, I guess, the micro branch, which is mostly a lobby with some ATMs and a couple of staff to help people out. The retail branch locations you see in establishments like Kroger's or Walmart are another example of that experimentation. So I think that we're going to continue to see a lot of experimentation with different ways of providing physical locations. And we're just trying to remind people that there are impacts to these closures, and to think through how those can be mitigated. Especially concerning is the CRA modernization effect. Whereas branch closures happen, essentially banks are possibly less incented to make loans in low to moderate income communities or to engage in community investment than they would otherwise be. Let me see here. There are a whole bunch of questions in the chat. What is the keyword again to search to get to the interactive mapping tool? There was a question, Jed, in here. Can you try and help out? What's the keyword to search to get to the interactive mapping tool? I think you mean the one that's in the report where you could just type in the name of the community. Jed, can you explain what it's doing there?
By keyword, is this like more like you would search on the tool itself? Or are you asking, I'm wondering if you are talking about if you're searching for the geographic scope, because if you're looking for the tool itself, I believe it's in the 5th section of the report where it talks about branch changes during the pandemic era. And if you were to scroll down, it should be on the website where the report is held in that 5th section.
Yeah. A few other questions here. Let me see here. Herschel, I don't know if you can save the I think it saves the chat somehow. Chloe might be able to answer that better, but I'm not sure. A couple of questions about credit unions again, and have you seen any examples of communities open a credit union on their behalf to support their own banking needs? Would this banking model work for larger? So we have heard of cases where branches were going to be closed by banks and the branch was instead sold or taken over by a local credit union for just that purpose. I think it's an interesting, I've been a credit union member all my life, and I think that it's an interesting idea that communities where there are no locations, rather than seeing a payday lender or a check casher come in to take that place, that a credit union would be an excellent alternative to it. The option to save the chat is not available, I'm being told in the chat. So it looks like we can't do that. Actually, there are a few more questions in the chat. Let me take a look through here. Dwayne notes that there are technology barriers that prevent a lot of low-income folks from using online banking for deposits, et cetera. Yeah, I mean, that's true also. And I think, how many of us, when was the last time many of us deposited a check? It's just not a very common exercise on a regular basis for many people anymore, but that may be different, in a low to moderate income community. So, and that kind of goes back to my point that when a branch closes, I don't think it's sufficient to treat every branch closure the same. You need to look at specifically what roles is that branch filling in that community, and think about how you can transition that community to another safe form of banking. That so we'll see. Lots of comments in the chat coming in. Let me just take a look through those and see. Okay, great. Chloe is going to send out a copy of the chat. So the chat does save as a text file, I know, but I think it only saves on Chloe's computer. So she'll share that for us. That'd be great. Another question about credit unions in the chat. Do you have a sense as to where credit union closures are greater or less than banks? Honestly, I don't. And I think that this is something we should definitely turn our attention to and see how that's going. Credit unions usually have a different role in the community anyway, but I don't know. I think it's a great question. Let me see here. I think I've got most. Oh wait, more questions coming into the Q&A box. Let me see. A few questions here. Somebody noted, are they conducting more business remotely? Obviously, yes. I mean, there's a lot more obvious, going on remotely via chat, via calling, via the websites, via mobile banking. A great source for learning more about how people are using banks is the FDIC's biannual survey of bank consumers. It's a large scale survey that they do, and we spoke to their research team a few months ago about their latest report. But it does a great job at looking at how individuals use banking and how that's changed over time. So the way people move into online banking, the differences based on income and other factors are really interesting. And it kind of gives you a great snapshot of how consumers really think about banking and how they want to and how they did so. Brian's asking, is there any insight as to why bank closures were down in Chicago in 2021? And no, we haven't delved into real specific metro level analyses like that. I think that's a really interesting kind of outlier, because we saw that too. And that may be for a number of reasons. Mergers do drive a lot of bank closure activity. Whenever there's a large merger, often if there is an overlap in the branch footprints of the two banks that are merging, a key element in their investor relations is to note how much they're going to save by closing branches. And it's possible there have been several big mergers over the past couple of years that impacted Chicago. There could have been a flurry of closures prior to the pandemic that buried the pandemic increase in closures. You would have to look specifically at Chicago area locations and the individual banks themselves to see how they what their history looks like. What should household and small business owners be doing right now? Thinking through how they are banking and how they are using a local branch, and thinking about how they will adjust if that branch goes away. In particular, this is something I'm hearing from people in rural areas. Where, especially in an area that has somewhat difficult terrain. For example, I was talking to a member of ours in northern New York, upstate New York, and the last branch in the county was closing, and it was a 15-mile drive to get to the nearest branch. Now, if you live in some place like, Texas or Florida, 15 miles is a it's not easy, but it's not hard to get to. In upstate New York, in the middle of winter, when you're separated by a mountain, it's a different story. And if you're a business owner that needs to drop off your receipts at the end of the day, the last thing you have is 2 hours to go and make a drive to drop off those receipts and come back. So, I think that right now, business owners and households should be thinking through, who do we bank with? Do we need the branch nearby? Are we comfortable with online banking? And if not, how are we going to respond if that branch goes away? Let's see here. So we've got quite a bit of time left, and I've got a lot of questions. I'm going to try to get through as many of these as possible. If you have any other questions, or if I just don't get to yours, I apologize. Please send me an email, and I'll do my best to answer it then. Luke has shared the household survey from FDIC in the chat. Thanks, Luke. That is a great product. It goes back many years. You can look back over time and see long-term trends and how people use banks and banking. And a lot of that deals with branches also, but also other kinds of products. And it tells you more about how, how people use alternative financial products like check cashers and payday lenders, and why they choose to do so. And often they cite as one of the top reasons that there simply isn't a branch that's convenient to them. So they make use of alternative providers just like that. In fact, I just had a major bank close their branch about a mile from where I'm sitting right now. A couple of years ago, it is now a Western Union, and they also sell prepaid phone cards. And that's really common. We see that kind of transition where banks move out, alternative financial providers move in. Public banking. Gabriel has a great question here. How do you think, if at all, public banking would affect branch closures if public banking were to pass in New York State and the city? That's a great question, and I don't know the answer to it. For example, so if there was a public bank, and postal banking is what I'm most familiar with, the idea that post offices can provide limited banking services such as check cashing and that sort of thing. My sense is that for a bank that's CRA regulated, I think the branch is more about foot traffic and claiming market share. So I don't know how much it would be affected by that, but I think the community would be positively affected by it if they had some type of a alternative that was not a payday lender to go to when the branch closes. Let me see here. Ruth Johnson notes, in most Detroit neighborhoods, folks go to bank branches for notary services, photocopying, meeting spaces. Most folks use cash, whether from banks, credit unions, or check cashing, payday loan shops. Yeah, exactly. So, in some communities, these branches, fill a number of roles. And that kind of goes back to my point that mitigating the impact of closures includes looking at what specific branches do for that community and thinking about ways to, to reduce the harm that comes from the branch closure. Okay. So Housing Action Illinois Policy Advocacy asks, are there indications that banking centers are emerging geographically as banks close branches in many areas? So what I think you're asking there is, are there examples of clustering in the data? Are the closures, in certain areas, are they all over? And frankly, the pandemic era closures look like they are all over the bank footprints. And that, that kind of, and that differs from community to community. In Phoenix, for example, there was a higher closure rate between 2017 and 2021 in low to moderate income majority communities than in other areas. Yet in some communities, we see that there's fewer branches closing in those areas. But to start with, since there are often fewer branches in low to moderate income census tracts in your community, even a smaller number of closures can have a larger impact. So you really need to look at, and you can take a look at the interactive map that Jad was showing off there. Look at your community and set the time at the bottom to a specific time period you want to look at. So for example, you could set the dates to March of 2020 and through today, and it'll show you all the branches that closed in your community during that time. Zoom in and take a look and see. In many areas, it has been the case that banks are conscious about the fact when they close branches that they need to do so equitably, meaning that the banks make a decision that we're closing 4 branches. We're going to close, let's just say, 2 in the low to moderate income areas and 2 in middle and upper income areas. But overall, if those low to moderate income areas already start with fewer banks, then the impact of those closures is going to be greater in those areas. So, and like I said, this report does not dive into a really detailed metro level analysis, but we do have the data, and between the Fair Lending tool and this report, if you want to take a look and gather a little more information about where branches are in your community and where they're closing, you can do so. And if you're a member, give me a call and we can actually help you take a look at that and maybe pull some additional detailed data together for you if you want to try and do some analysis yourself. Let me see, we got a couple more questions here. Yeah, Alicia asked a good question, and it's a map question. I just want to kind of touch on it. And Bruce or Jad, if I make a mistake here, please let me know. Alicia asked, why is there such a higher closure rate in the eastern half of the U.S. compared to the western half of the U.S.? There probably isn't. What you're seeing there is what's called map bias. The United States is incredibly dense on the eastern coast, and it gets very sparse as you go west until you get to the coastal areas around California. So whenever you look at a map of this, what you're really seeing is a population density map. We would need to do some more analysis to see if there really is a difference in the closure rate in different areas, and we would normalize that normally by the number of people that live in that community. Yeah, so yeah, don't read too much into that. The map is useful for zooming in and analyzing specific metros, but at the national scale, it probably does introduce a bit of map bias if you just look at it that way. And Alicia's asking another hard one. Is there a relationship between Republican versus Democratic states and closures? I don't believe so. The closure rates in New York and California are very high. They're also very high though in Florida and less so in Texas. But we didn't really look at it that way. But again, if you want to, let me know and I can help you get the data that we worked with, and you can look at it in that manner. Taya French noted in the chat that there's a link that they put in there. When the only bank in a low-income town in East Palo Alto closed in 2011, a credit union from a neighboring city moved in to serve the community. Yeah, and we do hear of that from time to time. It's a great, it's a great move. It would seem to be a good solution for both the community and for the credit union. And I would hope that we would see more of this, as these branches close and especially in areas where we know people are not going to flock to online banking as quickly. All right, so there's a great question in here from Housing Action Illinois. How can community groups more quickly access data on when branches are closing to be able to try and help mitigate the impacts when they might have when they close? So branch closures are not well communicated, I don't feel, prior to the actual closure happening. However, the FDIC does get notifications when branches are closing. The OCC, when an OCC regulated bank is going to close a branch, the OCC will put out a bulletin on their website about, usually several months in advance. But those are rather difficult to get to and use. We have in the past published those, but it's very difficult to do consistently because of there's a technological barrier there. So we are working on developing more tools that allow members to see almost in real time when branches are closing. But in terms of advance warning, we get very little advance warning. And that's where communicating with local banks comes into play, where you can kind of get an idea from them, hopefully in advance, of when branch changes are coming. If you're working in a community right now that especially one that has few branches already, I think it's a great idea to reach out to those banks and talk to them about those branches and see if they'll share with you what their plans are. One thing I think the pandemic data teaches us is that when they have the opportunity to, banks are eager to close branches more quickly. And I find that very concerning. So I would hope that you can take a look and see what branches you might consider critical to the areas that you service, and talk to those banks and just let them know we're watching, and we do want to make sure that if this branch is closing, that we're talking about the impact on the community and how we can resolve that. I am trying to get through all the questions here. There's one from, let me see here, Brandon Kelly. Has there ever been thought of using the shared branching credit union model for banks, where you can have one facility with multiple banks sharing space in an LMI community, lower cost, but access to LMI communities? Not to my knowledge, but it sounds like a fantastic idea. What you are seeing is banks move to, more in some communities, more of a micro branch model. And I've seen examples of that mostly in urban areas like DC and New York, where they're talking about lowering cost. In the postal banking discussion, there is one idea with that is, and if you're not familiar with it, postal banking, just means that the post office would start using its banking powers again. So the post office is legislatively allowed to offer, say, savings accounts and issue checks and things like that. There is an idea that if they were to start doing that again, rather than have postal employees do the actual banking functions, they would contract that out to an actual bank that would come in and co-locate in the post office. So that's kind of a version of what you're thinking of, and it does have several advantages, I think, in that you could locate those in low to moderate income or rural areas where post offices already are. Whether or not it's feasible, I don't know though. Thanks, Phyllis. I think that I answered most of the questions I could. Let me see. Oh wait, there is another question here in Q&A. Have you developed a map on where bank branches continue to exist? Would this help us evaluate how branches are spread out, particularly in low to moderate income communities? So there is a bank branch locator on the website at ncrc.org. You have to sign into the website. So if you're a member of NCRC, you can do that. If your organization's not a member, then you can also join our Just Economy Club as an individual, and that would give you access to these tools also. Just a couple of notes about the data though. The data for this report comes primarily from two sources. One is the summary of deposits file that comes out June 30th of each year from the FDIC. And the other is their bank branch change files that come from the bank find suite, and that's updated weekly. The summary deposit files are what are used primarily for looking at bank branch locations. However, there are problems with it. About 5% of those records do not appear to have valid address information. So often they're not located correctly on a map. We've done a lot of work. Jad's done a lot of work at getting that fixed. So the bank branch locator should give you an accurate look at where banks are in your area. Also, you can take a look at the Fair Lending tool, which is also on ncrc.org. The Fair Lending tool lets you look at mortgage lending, small business lending, and bank branch locations, and how many of those branches are in LMI or majority communities in your city. If you have any questions about that, just let me know. And if you're interested in getting a preview of the Fair Lending tool, if you're not yet a member, contact me, and we do have a preview version that's has some limited function to it, but it'll give you an idea of what it does. And then I can connect you with Maggie to talk about membership as well. Somebody asked at the end of the call, can we send out some of the resources outside the report that were mentioned on the call today? It would be helpful. A lot of those are linked in the chat, and Chloe is going to be sending out a copy of the chat after the call. So it should have, I think all of those are there. Oh, and Chloe's also asking to remember to rate the session before you go. If you look at the chat, you gotta scroll up a couple of comments, but there's a link to a WooFoo survey form. Click on there, go to it, and tell us how you think we did on this webinar. Oh, Sage has a good question. How has the increase of shadow banking affected the level of closures related to banks? Square, Cash App, Apple, PayPal, Venmo, yeah. So, I mean, those are mostly payment services of one type or another, and that used to be, a function of banks primarily, and most of these are associated with banks in some way also. But I don't know. The newest version of the unbanked survey, or the survey from FDIC, does get into this a little bit, but I think it's still an evolving area, and I don't think we really know how big the impact is yet. Most of those, the ones that you mentioned there, are payment processors in some way, and that's that's always been something that banks drew income from in certain ways. So it has to play into it at some level, but to be honest with you, I'm not really sure. Okay, well, it looks like I think I answered. There honestly, guys, there were a lot of questions in the chat, a lot of questions in the Q&A. I'm sure I missed a couple of good ones. My email is jrichardson@ncrc.org, and I'm going to put that in the chat also. I think I was linked somewhere else, but if I missed your question, please email me, and I'll do my best to answer it. Bruce, Jad, did you have any other comments before we wrap it up? Excellent. All right. I appreciate all of your time. Thank you very much for being members of NCRC, and have an excellent day. Bye-bye.